All right, good morning, NAGDA members. I'm Matt Petersen, NAGDA's Executive Director. We appreciate you taking time out of your unusually busy schedules right now to join us today. It's certainly a different world than it was the last time we spoke. And our goal with this webinar is to provide you with some information to help navigate these very turbulent times. Today, we'll be talking about the market and participant communication in the midst of the COVID-19 crisis. To do that, we're very fortunate to have two of the nation's foremost experts with us to lead the conversation. First, we have Dr. David Kelly, Chief Global Strategist at JP Morgan, and who will give us his perspective on the market and discuss what he sees as the most important issues facing DC plan sponsors today. He'll be followed by Michael Knowling, Head of Client Relations and Business Development at Prudential, who will discuss communication strategies and techniques for you to use with your participants during the crisis. Gentlemen, we thank you both for being here with us today.
Thank you.
A few quick things before we get started. We're recording this session. It will be emailed to all of the attendees and registrants and posted on the website soon after we finish. So if you missed something, you can go back. You will be muted for the duration of the webinar, but please submit questions for the speakers throughout the presentation in the Q&A box down in the menu bar at the bottom of your screen. Your questions will only be visible to me and to the speakers, so please feel free to send them whenever you want, and we'll answer as many as possible at the end. We also have the chat feature open, which you may use to chat with your fellow attendees during the presentation. Just realize that the default setting on that is just to the panelists. So if you want to change it to panelists and all attendees, you can. But note when you do that, that everyone sees what you type in. With that, let's begin. Our response to the pandemic has caused some really wild swings in the market. Dr. Kelly, as Chief Strategist at JP Morgan, you're someone who's tasked with thinking about the long term. What are you looking at today that helps you make some sense of what's going on? And how has that framed your thoughts about what the market might look like in the future?
Well, thank you, Matt, and thank you for having me on this webinar. I think that whenever you have a crisis like this, and well, there really hasn't ever been a crisis exactly like this, but we've had crises in the past where markets have been extremely turbulent and we're trying to figure out what to make of it all. I think the most important thing for analysts and for long-term investors is simply to have a structured approach to looking at things. The story may change, but the basic way you look at something shouldn't change. So in this case, what you really need to do is look at the disease first. You've got to have an understanding of what COVID-19 is and what it's doing. Then you've got to look at how that is impacting the economy because of our social distancing response to COVID-19. Then you have to look at the measures being taken by the federal government and the Federal Reserve to try and alleviate the situation. And then you have to think about, well, if you put all that in place, what does it mean in terms of investment implications? So those are the four things I'd like to talk about today. The first thing in terms of COVID-19 itself, I remember when this broke out, and particularly in January and February, there were people who were saying, oh, well, it's just like the seasonal flu. It's not like the seasonal flu. That's the problem. I think the key, we use our guide to the markets. I hope many of you there get our guide to the markets, but if you don't, you can just find it at jpmorganfunds.com. But in our guide, we track the daily behavior of COVID-19. And the problem is, to see what this bug basically does, you have to go back maybe 3 or 4 weeks ago, before we were doing a lot of social distancing. So if you look at sort of the data from early March, and sort of track it forward for about 2 weeks, what you see is about a 200% year-over-year growth rate in the cases outside of China. Now, I think that was before people really got serious about social distancing, so it really tells you something about the nature of the bug itself. All viruses have basically co-evolved really with human beings to exploit our social nature. If we were all recluses and we all stayed far away from each other, then viruses would die out. But viruses in humans succeed because we interact with each other. And so a virus in any one individual is only going to survive for a few weeks, then the virus is dead or the human's dead. That's kind of how it works. But because we interact, that's how a virus keeps spreading. What do we know about COVID-19? What we know is that before we all started social distancing, this thing was growing at about 200% per week. That is a frightening rate of growth. If you have 1,000 people who have the disease right now and you don't do anything unusual, then in 1 week it's going to be 3,000, in 2 weeks it's going to be 9,000, 3 weeks 27,000, 4 weeks 81,000, 5 weeks 243,000, then 729,000, then over 2 million, then over 6 million, then over 18 million, then over 54 million within 10 weeks. That's what happens within 10 weeks. there are 330 million people in the United States. You can see that within 3 months, basically half the population have this. That's what it would do without social distancing. Now, could we allow that to happen and just gain herd immunity? Well, the problem with that is that if you look at the mortality rate, this thing is just too grim in terms of its mortality rate for us in good conscience to allow that to happen. So far around the world outside of China, the overall mortality rate is running actually at about 5%. And in the United States, it's running at about 3%. That is to say, the total number of people who've died from it so far is about 3% of the total number of people who've been confirmed to have had it. Now, that number itself is an overestimate of how lethal COVID-19 is. We know the number is going to be lower. But I take my cue actually from the data from South Korea, where they tackled this thing. They got a big outbreak early on. They tackled it. They seem to have conquered it. But they're up to about 10,000 cases. The number of cases only grows by a few dozen every day. So they've basically, through whatever, managed to, in terms of social distancing and massive testing, which have done much, much better than we have. They've managed to control the thing, but their mortality rate right now is running at about 1.8%. Even that, we hope, is an overestimate of what this eventually will be. There are presumably over time better treatments. We'll learn more about it. But even if the mortality rate were to be 0.5%, there are 330 million people in the United States. 0.5% is 1.65 million people. You can't really, in good conscience, allow 1.65 million people to die from this thing because everybody gets it. So what you have to do is basically see if you can stall the disease until you get a vaccine. When are you going to get a vaccine? 12 to 18 months, they tell us. So, hopefully next spring, but that's basically what we're looking at. What do you do in the interim? Well, you've got to try and do social distancing to flatten the curve. And we have succeeded, I think, in doing that to some extent. Right now, the number of cases seems to be stabilizing at about 30,000 new cases per day in the United States, with a mortality number of a little over 1,000 people per day, which is a rather shockingly high number. I mean, if you think about that over a year, if it's 1,000 people per day, it's 365,000 people per year. It's still huge, but it's not as bad as a worst case scenario. The problem is that we have achieved this stabilization, or seem to be achieving this stabilization, through dramatic social distancing. We've had to shut everything down. And the real question we've got to ask ourselves is this: if we don't have a vaccine and we reopen while we're still running at 30,000 cases a day, isn't this thing just going to get out of hand again? Isn't it going to just basically triple every week? If you send all the kids back to school, if you send all the workers back on transportation, back to the office, you open up the restaurants, you open up sporting events, you can't control this bug. The bug's going to win. So, for medical reasons, we want to flatten the curve because that reduces the pressure on the ICUs and hopefully helps with mortality and the doctors and nurses and everybody else on the front line. But from an economic perspective, we cannot be satisfied to flatten the curve. We would really need to crush the curve. We'd need to push down the number of new cases down to 10,000 per day, 5,000 per day, 1,000 per day, and then have dramatic tracing of this thing in terms of a lot of testing and basically contact tracing, whereby you find, okay, patient number 759 contracted this. We caught up with them on day 3 of when they think they had it. These are the people they were in contact with. Let's lock that patient down. Let's lock these people down and see where we can go. But you can't do that with 30,000 people every day in the United States. You have to get that number down to a workable number and get testing up to a much more extreme form to do this. And so that's where we are. What do I honestly think is happening? I mean, honestly, I think there's going to be an attempt to reopen the economy, I suspect, in the middle of May, maybe the start of May. I think the numbers will be down for a while. Then we're going to gradually try to get back to normal. And what that's going to do is going to push the numbers up again. And we're going to be caught in this uneasy equilibrium where we can't really reopen the economy properly, but we don't quite squash the disease so completely that we can return to normal either. So I think that's probably where we're going to be. Now, I would emphasize for people who are long-term investors, I know that sounds gloomy, and I hope I'm wrong, but you don't have to be an optimist on the disease to recognize that there's long-term value in stocks. You don't have to be an optimist even on the economy to recognize that there's long-term value in stocks. And I'll get back to this, but 2020 is the year of the virus, but stocks are a very long-term investment. So if you think the economy will recover, if 2021 is going to be the first year of recovery, by 2022 we're booming again, which I think will happen, then it still makes sense to look at valuations today and think soberly about whom to invest for the long run, rather than trying to figure out how the market's going to behave in the next few months or weeks. If you're a long-term investor, if this is your 401k plan, that really doesn't matter. It's not about the next few weeks. It's about the years and decades into the future. So anyway, that's where the virus is. In terms of the economy, it has pushed the economy into a big recession. We just saw another enormous number, 6 million unemployment claims last week. That now makes 6 and 6 and 3. So I guess we're at about 15, 16 million unemployment claims just in the last 3 weeks. We think that the unemployment rate overall will go above 10%, certainly, may go above 15% in the April employment report, which we're going to get on the 8th of May. And that will reflect the depth of the recession. I think we'll also see a drop in GDP of somewhere between 15 to 20% annualized. This will make it the biggest recession since the Great Depression. But I don't want to overemphasize that, because it's going to be technically a huge recession. But because of what the government is trying to do, and because we know there's an end game here, it's not like the Great Financial Crisis or the Great Depression, in that we do know what the problem is here, and we know that it's a limited period of time. It seems forever to wait till next spring, but it's still, from an economic perspective, a limited period of time before this problem goes away. Now, what I think is going to happen is we're going to have a U-shaped recession, a fall, a stall, and a surge in 2021 when we have what I will call VC Day, which is Vaccine for Coronavirus Day, and we all line up 6 feet apart outside our Walgreens and our CVS's to get vaccinated. When that happens, the economy is going to come roaring back, and it will. But until then, we've got significant problems. So we've got this big recession. I think the next thing to look at is what the Federal Reserve and federal government are doing. The Federal Reserve, frankly, is doing everything under its power to lend money to the economy. It announced some big programs today. It has been announcing multiple programs. It's cut interest rates down to 0. I think it's doing everything it can to free up financial markets, and it will continue to do that role. I do not think this is going to be a financial crisis. However, in life, sometimes somebody offers you a loan, and what you really need is a grant. And in Washington, the loan department is the Federal Reserve, and the grant department is the federal government. And so I think most of the important action will occur with the federal government. The CARES Act, which was just signed into law just over a week ago, that amounts to about $2.3 trillion of stimulus. And I think stimulus is probably the wrong word, because it's really about sustaining the economy. The idea is to try and maintain the economy as sort of suspended animation, where yes, you have mass unemployment, but you don't have the massive poverty that comes with unemployment, because between unemployment benefits and one-time checks to people, actually people are doing okay. And similarly with corporations and particularly small businesses, I think the act is designed, and I think future legislation will be designed to say, yes, you can have a situation where you've got to shut your doors, you've got no revenues, but that doesn't mean you go bankrupt. And we hope that you will be around to reopen your business come vaccine day. And I think this will actually probably work. I think we've already spent $2.3 trillion in that act. There's another $100 billion in a previous act. I think there'll be supplementals, because I think that the way this thing is designed, it's designed for about 4 months of this going on. Unfortunately, as I've said, I think that the recession associated with coronavirus will be U-shaped and won't be really over until 2021 in terms of a significant rebound. So I think there'll be more money, perhaps another $1.5 trillion spent on this. I think, though, will basically fulfill the function of keeping workers in a position to put food on the table, keeping small businesses in business. I think there are going to have to be adjustments. The unemployment benefits themselves, it doesn't sound like a lot of money, but an extra $600 a week. The problem with that for a lot of small businesses is if you add the unemployment benefits, the normal unemployment benefits, plus that $600 per week, actually for a lot of these low-paid workers, it financially makes more sense to be unemployed than actually to do your day job. And so we need to think about that a little bit, and you want to be generous to people, but also you want to be generous to these small businesses to help them find a way of getting back to work if they can. And there'll be lots of other businesses who will try and take advantage of the situation in a good way. There'll be businesses who set up home delivery. You're seeing that a lot right now. Home delivery of almost everything. You're going to see businesses, try to, we're seeing a lot of technology, just like we're doing today, in terms of trying to keep business going through virtual meetings, and lots of other businesses will grow up through this. That's where I think we are in terms of federal government, Federal Reserve. I would say one other thing about coming out of this. When we bust out of this thing, which I think we will in the second half of 2021, we'll have a lot more government debt. I think we'll have some inflation at that point. I think we'll have higher interest rates at that point. I think the Federal Reserve won't raise rates themselves until late in 2021, maybe the last meeting of 2021. But I think long rates will go up first. So, all this government debt, all the stimulus, unless we have the discipline late in 2021 to put the brakes on, and I don't think we do, then I think we may have some inflation out of this, which has some implications for the bond market. Now, finally, I just want to talk a little bit about where do we see investment implications. First thing, on stocks, we saw stocks fall very sharply down, 34% from peak to trough. The peak was just February 19th of this year, less than 2 months ago, incredibly. We went down 34%. We've come back a lot from there. We're only down about 19, 18% from the peak right now. I think those are pretty much fair value prices. We certainly could revisit the lows. People always ask me, well, are we going to hit the new lows again? We absolutely could, because we could get bad news in the virus. We could get bad news in the economy. That's true. But for a long-term investor, please don't try and time this market. The real question you should ask yourself is, at this point, are stocks good value or bad value or fair value? And I think they're probably about fair value. And the reason I say that is because people need to realize how much stocks are a long-term investment. If you think about the PE ratio of stocks, suppose you buy a stock with a PE ratio of 16 times this year's earnings. What does that really mean? I mean, the only thing that makes a stock valuable, the only thing that makes a stock more than a piece of paper is earnings, money that a company will earn and distribute through dividends or stock buybacks or through capital gains to an investor. And if a stock is selling at 16 times this year's earnings, what that really means is that this year's earnings account for 1/16 of the value of the stock. The other 15/16ths do depend upon earnings. It's just not this year's earnings. It's earnings next year and the year after that, and for years and decades into the future. And when you look at it from this perspective, so long as you recognize that 2020 is the year of the virus, 2021 is the first year of the recovery, by 2022 we should be booming again, then a stock market that's down about 18% from its peak of 8 weeks ago doesn't look like bad value. A second thing I'd mention is, think about what the market has done to your portfolio. If you were 60-40 at the start, 60% stocks on December 31st and 40% bonds, and you didn't do anything, and the stock dividends were reinvested in the stock market and the coupon payments and bonds were reinvested in the bond market, you're about 55% stocks, 45% bonds now. In other words, the movement of the market has made you more conservative. If you choose today to sell stocks and buy bonds, when stocks are cheaper than they were and bonds are more expensive than they were, recognize that you're adding to a conservatism that the market has already imposed upon you. That may not be the right thing to do. In fact, institutional investors would normally rebalance back towards stocks to take account of this. So if you're in a 401k plan, be careful about getting too conservative if that's adding on to something the market's already done to you. Third thing is, people often look for income producing vehicles in markets, and this is a tough time to find income. I would point out that because of how much the stock market's fallen, the yield, the dividend yield on stocks is now up to about 2.2%. The yield on 10-year treasury bonds is down to about 0.7%. So that's a 1.5% gap in favor actually of stocks. Now, over most of the last 60 years, the yield on a bond was higher than the dividend yield on a stock, because after all, stocks are supposed to give you a capital gain also. They're supposed to go up over time. But today you can actually get better dividend yields out of stocks than you can get from treasury bonds in terms of yields. Now, that doesn't mean all dividends are safe. I think you have to think about the industries that are going to get hurt by this, but there are plenty of parts of the market, financials, healthcare, utilities, where you're not really seeing much damage in terms of corporate earnings, and where dividends should be relatively safe. Fourth thing I'd say is, take a look at international investments again. If you look what's going on in East Asia, in China, and I am distrustful of the Chinese numbers, but look at places like South Korea, Taiwan, Australia, New Zealand. These places, Japan, these places all have the ability, because they are islands, with the exception of South Korea, which is essentially an island because of its North Korean border. These are islands which should be able to get out of this thing by strict social distancing. They're much more disciplined, and in the case of Australia, I think they've got a healthcare system that's better able to deal with this than we have. And overall, I think that the rest of the world is going to be more disciplined in getting to this early than we are. We may have been the last into this crisis, but I think we're going to be the last out. And if international stocks are cheap today, this may be a time to make sure you have enough money invested in international. And finally, I think this is probably a good time for active managers. I think this is a very weird type of recession. I've been trying to build models to try and explain what's going on. I've never had more trouble putting together a model of the economy which can explain the next 2 years. But that's also true for businesses. There are all sorts of weird things going on. There are technology businesses which will thrive in this. There are bricks and mortar businesses that will fail in this. There is a demand for real estate downtown which is going to go down. There's a demand for delivery services which is going to go up. And I think if you can figure, and then you've got to look at balance sheets, look at how governments are affecting balance sheets. But what you want to do is look at those companies which can weather this storm, but also thrive in a rebound. And I think this is a good opportunity for active managers to really work in these themes that no computer algorithm could figure out, given the complexity of the situation around COVID-19. So those are the main points I want to make, and I just want to pass back to you, Matt.
All right. Well, thank you very much, Dr. Kelly. That's fascinating stuff. Obviously, a very complex environment. Michael, it's a lot to deal with there. We talked about looking years and decades into the future, but also the markets are moving so rapidly right now. There's a lot of unknown. We're all uncomfortable with unknown. It's a lot of guesswork. We're all trying to think through it, and that creates a really tough environment for a plan sponsor who has to be responsive to their participants. You combine that with the fact that a lot of these teams are scattered. Now they're working remotely. How are you at Prudential approaching this situation with your clients to help them continue to communicate effectively, to think through all of this stuff with their participants and help them make good decisions? What have you seen out there?
Yes, thank you. Great question. And can you hear me okay?
Yes, we can. Thank you.
Perfect. Well, first of all, let me just say that I'm honored to be here today with Dr. Kelly, so thank you for inviting me. And I also want to just take a quick moment to say, on behalf of Prudential Retirement, just want to recognize and thank all of those that are on the front line, especially those in the public sector who are not only keeping us safe, but also their dedication and efforts are keeping some work moving forward in terms of essential workers. I think in this environment, it's important to recognize them, and on behalf of Prudential, we just want to make sure we recognize and thank all of those individuals. So as you were saying, the coronavirus pandemic has really caused a great deal of turmoil, as we think about market volatility. And to your point, what I'd like to do is take the next few minutes and really just talk about some of the insights that we're seeing in terms of participants. Secondly, the behaviors. So what does that translate into the actions that folks are taking? And then thirdly, get into specifically, how are we helping participants in terms of communications in this time? And so if I start off with the insights, it's important to know that, especially as you think about the public sector, what's a little bit concerning is even before the coronavirus pandemic, financial wellness and savings and investing was challenging in that sector. And back in 2017, in fact, Prudential sponsored a survey with the Economist Intelligence Unit. And in that survey, we surveyed over 1,800 public workers. And what we found is overall, folks were confident in financial planning decisions. However, they were less confident in decisions as it relates to saving and growing income. And so you think about that in 2017. And a lot of that behavior was really driven by the fact that people had a lack of understanding and still have a lack of understanding of just the interest rates, around inflation, around market volatility. And I think you heard some of that play out in Dr. Kelly's comments. So if you use that as a backdrop, and then also think about from a public sector perspective, as you think about the priorities, the top 3 priorities are as follows. Number 1, people are trying to manage debt, and they're trying to make sure that they can do that effectively, and they want to pay down debt. And then secondly, they're looking at how are there ways that they can put money aside for an emergency. And then thirdly, once that's all done, they can start to begin to think about, how do I start to put together and build towards a nest egg? So there's competing priorities in terms of challenges that get in the way from them, basically saving. And this environment compounds that even more. And one interesting stat that I'll share with you before I move on and talk about some of the behaviors is 63% of the individuals out there today do not have $500 in an emergency savings vehicle or account. So if you think about that, 63% of the people do not have $500 saved for an emergency, and how that plays out in this type of environment. So with that as a backdrop, let me share with you some of the particular insights that we're seeing. And first, I'll talk about what we're hearing from participants directly, and then I'll talk about some behaviors that we're seeing in terms of savings rates and investments and so forth. So I'd like to just take a minute and read off 3 quotes that we've heard from individuals. We have, in this environment, we have our folks out there conducting virtual one-on-ones. And what we're finding is you have people that are in 2 camps. You have people who just want to take action. They have an immediate need to have access to dollars to pay bills, and they're just looking for access to those dollars. And then you have a whole set of other individuals who are just looking for information because they have concerns around the market and they're wondering what they should do. And here are the 3 quotes that I'll share with you, which will give you a really good flavor for how people are feeling in this environment. The first is, we heard from many participants this: I thought it would be nice to discuss my investment selections and listen to your thoughts about the market during this difficult time. So what they're saying is they just want to hear what are some of the considerations in terms of long-term, short-term, et cetera. Second, the question is, should I stop contributing now and restart my contribution later? And as you think about that, think about Dr. Kelly's thoughts around how in a retirement program, it's really around a long-term plan. But with all the market volatility, it certainly has people uneasy, and they're asking, should I stop my contributions now and restart later? And then the third quote is, I need help in securing my money. What would it take and what do I need to do to move my money to low risk investments? And again, as you think about the behavior and the reality around the market volatility, people are struggling with decisions around keeping that long-term approach in place. So that's what we're hearing. So what are we actually seeing in participant behavior based on that? So overall, I think the good news is we're seeing a minimal decrease in saving rate changes. By and large, as we look at the Prudential book of business, we see that only 2% of the people are really making those changes. And those changes could be either up or down. And I can tell you over the last 4 weeks, it's been all over the place based on how the market is behaving. Early on, as you would imagine, we've seen people decrease savings rates. And now we're seeing a little bit of a trend where people are starting to increase. The second behavior that we're seeing is, as you would imagine, a lot of people are actually taking action around investment changes. So as we look at year over year, this period for the same time last year versus this year, we're seeing an increase of nearly 500% of individuals making investment changes. And primarily what people are doing is they're moving to safety. So they're moving from equity funds to safety, and that is either a stable value fund or an equity fund a stable value fund or a fixed income fund within the retirement program. And so you do have people who are anxious and they just want to get to safety and they're taking action. And then the final trend that we're seeing here has to relate with distributions and withdrawals. As you would imagine, early on, thematically, we're seeing a modest increase in distribution-related activity, 16%. But we are fully expecting that will increase with the passing of the CARES Act. The activity that we've seen thus far has been primarily concentrated in those states that have provisions in their plan, natural disaster provisions in their plans where they have access to hardship withdrawals because of a natural disaster. But with the passing of CARES, we are expecting over the next couple of weeks to see a spike in activity of withdrawals in distributions. So as you can see, with participant behavior, there's a lot of uncertainty. People are either in the camp of, I need access to funds immediately, but more so people are in the camp of, help me through this situation and how do I manage my account during this period. So that brings me to the final area that I'll talk about for just a couple of minutes, and that is how can we best help participants with communications throughout this process? And I can share with you some of the things that we're doing here at Prudential. And I can tell you that, certainly, across the market, many of the providers are taking similar approaches. But first of all, what we're doing is we're looking at our approach threefold. The first is we are working with our plan sponsors to send direct communications to participants. And these communications are providing question to answers around questions around market volatility. And there's a lot of questions around what should I do, what are some of the considerations, et cetera. And so we're helping employers by sending those communications directly to participants. The second thing that we're doing is we're building off of the virtual one-on-ones to complement our call center. So if I talk about our virtual one-on-ones, as you would imagine today, unfortunately with social distancing, we are unable to meet with participants in person. But we're seeing an uptick in the ability to engage with them virtually. And we've allowed participants to sign up at a time that works best for them. And we've created special hours recognizing, especially for those essential workers, that they'll need appointments either early in the morning or in the evenings. And we want to make sure that we can accommodate them. But we're seeing a big increase in folks signing up. And thematically, as you would imagine, it's questions around what are some of the considerations, what does this market volatility mean for me? In our call center, we are talking to participants, and we've actually set up a dedicated team to answer questions specific to market volatility, as well as CARES and the coronavirus. And again, you have some people who are just looking for information, and we want to make sure that they have access to those folks in our call center. And following that discussion, we're finding that some of those participants do want to take action, and so we want to make it easy for them to do that. So we're connecting with participants virtually, but also have our call center reps available to speak with them. And then the final area that we're working with participants on is we've created a special market volatilities communication center on our website, as well as access to that center through our mobile app. And what we're finding there is we're looking to give participants a landing spot where they have access to all the information that they might need. So think of it this way: it's access to on-demand webinars, access to live webinars, access to content around market volatility, but also there's a host of calculators and other tools that are easily at their fingertips so that they can actually begin to model out different scenarios that are specific to them, but also have awareness around the tools that are available to them in their plan. And the whole idea there is we want to meet participants where they are. And as you think about our communication approach in general, it is allowing participants to interact with us virtually by phone, but also on demand on the website. So that's how we're thinking about the communication approach. And I know that NAGDA has demonstrated, leadership in this space also by making some information available in the government market by the materials that they created on their website. So I want to acknowledge that and applaud that as well. So in conclusion, what I would say in this environment is, by and large, participants are looking to access for information. They want to understand what are some of the considerations that they should think about near and long term, as Dr. Kelly mentioned. And then they're looking for the tools that will help them in that process, in that decision-making process. And what's important, if there's one thing to take away for everyone on this call, is the more communication that you can do and the more that you can give participants the option to either self-serve or to talk to individuals, and I'd say talk to individuals virtually in this market, that's the best way to serve them in this environment. So I'll stop there. Hopefully that gives you a sense of what we're seeing, but also some things to think about in terms of participant communications.
It does. Thank you. It's a very complex mix. Dr. Kelly, do you have any thoughts? I know you were writing some stuff down there, or else we can get into the straight into the Q&A on anything that you heard.
No, I very much agree with what Michael was saying in terms of communications, but I'd prefer to just get into the Q&A.
Okay. A lot of it's around the CARES Act, as you can imagine. New legislation came down. People are trying to understand how it's going to impact them. One question we had for Michael was why would you expect more withdrawals with the CARES Act? I think from the 457 side, the 10% penalty is already waived, but overall, why would you expect to see some more withdrawals now that the act has been passed?
Yeah, that's a great question. And the way that we're looking at this is, and this ties into some of the comments that Dr. Kelly shared in terms of unemployment rates. But as we look at specific industries that were hit very hard by this crisis, you think about manufacturing, you think about hospitality, you think about some of the groups that are experiencing furloughs. In those situations, we are seeing that there is a high demand for access with withdrawals. And quite frankly, already we've seen a slight spike increase in withdrawals just with states that have natural disaster relief. And you have participants who are coming in and asking for distributions. And then geographically, we're seeing this especially in the New York, New Jersey, Pennsylvania, and Nevada areas where there is a high concentration of clients that are in manufacturing as well as hospitality. So we are preparing for that. We've actually staffed up to accommodate those requests. And then finally, we created the special team within our call center to help participants throughout that process.
Yeah, it's a real balance. It's something that we did sign on to the legislation and advocated for it, but it's also something, like Dr. Kelly mentioned, keeping the long view in mind is very important. Everybody's situation is different. So the tool is important, but want to be used certainly with caution. Have you seen any issues with implementation of the CARES Act? That's a question that we received as well. And actually, from the plan sponsor perspective, being able to put all of the mechanisms in place, all the get everything in line so that you can actually execute on it?
Yeah, that's a great question. So we are taking really a consultative approach with our plan sponsors, just to make sure they understand all the considerations with adopting certain provisions under the CARES Act. And quite frankly, we've seen it all over the board in terms of different sponsors electing different provisions. But to give you one example of one of the things that's important to understand is one of the provisions allows participants to delay loan repayments. And if you think about that in itself, what that's going to require on the plan sponsor side is for them to modify their payroll files to have the ability to stop and then restart loan repayments. And then it's going to require communication with participants as well in terms of the timing to start and restart loan repayments. So those are the types of conversations that we want to make sure that sponsors understand before they elect some of the provisions. One other example is under the withdrawal provisions, in particular, if the participant has the ability to repay the withdrawal within 3 years. And what's important for participants to understand is it's important for them to consult with a tax advisor to understand the tax implications and the need to potentially amend tax returns in the event that they do decide to return any of the withdrawals that we're taking during this time. So it's just making sure that they understand some of the trade-offs and implications if they not only adopt some of the provisions, but if participants actually make those elections.
Okay. And Dr. Kelly, I wanted to turn to you for a question that we received about active and passive management. You mentioned it when you spoke for a bit. You also talked about the difficulty in the market and thinking about it as a U-shaped market or a U-shaped recovery potentially, but the difficulty of timing all that out. I wanted to see if you could flesh that out a little bit and talk about where you see, it's a topic we talk about often here, the advantages and disadvantages of active management versus passive, just how you see those movements going forward and those two views on investing.
Sure. Well, I think first of all, in terms of the U-shaped recession, normally what we see in the stock market is the stock market tends to hit a bottom before the economy does and begin to recover before the economy does. And that's very consistent over many recessions. So I do want to make that clear to start with. I'm really talking about the shape of the economy more than the market, which will probably tend to lead that. In terms of active management, I think if you've got a trended market, a market which is just chugging along, doing its thing, growing fairly steadily, then it's easy for the market to get a little bit out of whack with money just pouring into, for example, large cap growth stocks. We saw were doing very well for a number of years here, and small cap value stocks were lagging behind. But there's nothing really to change that dynamic, because what happens is, for example, if you've got portfolio managers who are investing in small cap value stocks and people are withdrawing money from those funds, they actually have to sell the stocks, and that's putting downward pressure on the market. And similarly, if everybody's just contributing to these large cap growth stock funds, it tends to put money into those funds, into those stocks, and cause them to go up. And that can cause some stocks to become overvalued and some stocks to become undervalued. We've also seen the same thing with the United States and international investing, where US investors were putting more money into US stocks, taking money out of international stocks, and that would tend to widen valuation gaps. And that can happen when not much else is going on. And in that kind of environment, it's hard for an active manager to do very well. But if you have a change in the environment, a sudden change in the environment, then the first thing is that a manager who's really thinking about valuations carefully ought to do better in a sudden downshift, because it tends to be the case that things that are most overvalued actually get hurt the most in a downdraft. And so that's one opportunity. But the second, and to some extent that may already have occurred, but the second point is when you try and figure out, well, okay, now which companies, let's try and figure out how this recession is going to play out. Let's think about which companies actually have the balance sheet to get through this, which ones don't, which companies are going to benefit from various government lending programs and grants, which ones don't, which companies are invested in the kinds of technologies and the kinds of areas of the economy that should thrive in this sort of amalgamated social distancing normal economy that I think is going to emerge. I think all those require thoughtfulness. And so this is an opportunity for thoughtful active managers, I think, to get ahead of sort of just blindly buying the whole market. So this should be a good environment for active managers. Of course, we believe that there are opportunities in both active and passive in investments. But I think this kind of disruption should help those who are applying a little bit of human intelligence to the purchase of equities.
All right, thank you. That's very helpful. We have another question, Michael. This one might be more for you. This is something that we've discussed. We're actually going to put out some more information about this today with regard to the CARES Act for 403B and 457 plans. There are some distribution provisions. Do you think it's prudent to offer distribution provisions for a 401A, which often serves kind of a different function and more of a pension-like function on the DC side? We've had a little debate about it internally with our legislative committee. Wondering if you've talked about it at Prudential at all and if you have any thoughts.
And I'm sorry, is that, so just want to make sure I'm clear on the question, is that RMDs related to the types of plans?
No, in-service distributions from 401As, like with regard to the CARES Act and the new provisions that were offered through CARES.
Okay, just in-service withdrawals in general, you're saying?
Yeah.
Yeah, and I think it goes back to, similar to what I was saying earlier, you probably need to look at it on a case-by-case basis, depending upon, the type of employer, and then as you look at their employees, is there a need to make that type of consideration based on the employment status? Different agencies, I think, are impacted in different ways, where we have seen in some situations there are furloughs and there may be the need to have access to cash. But then also it is the consideration around the tax implications in the event that someone does take a withdrawal. So it's hard to give an answer that is general, that to apply to everyone. You really need to take a look at it on a case-by-case basis. In fact, one of the decisions that we've made here at Prudential is we decided rather than making broad or global decisions for plan sponsors in terms of which provisions to enact, we decided we wanted to have individual conversations with all of our plan sponsors because, again, on a case-by-case basis, some of the provisions may or may not be in the best interests of the employer and individuals.
Got it. Thank you. Dr. Kelly, maybe one for you. This is kind of a big question. Considering the political climate between the U.S. and China right now, what are you looking at with the Asian market over the next few years? How do you view that? A lot there, but
yeah. No, I would be relatively optimistic about Asian markets over the next few years because, as I said earlier, I think there are certain countries who are important in East Asia, including Taiwan, South Korea, and of course Australia, New Zealand, Hong Kong, who I think have really tackled this virus in a way that will allow them to get back to normal. I'm a little bit more suspicious of the Chinese numbers. Again, this virus is not going to behave just in a way that is suitable for is convenient. But the Chinese government has said that they have the number of cases topped out at 80,000 and it's stopped rising, and so everybody can get back to normal. I would not be a bit surprised to see a second wave there, But I also am cynical enough to believe that the Chinese government might say, well, that's just the way it's going to be, and we'll just keep on going. So that would not surprise me. But from an investment perspective, if you leave those political considerations aside, I do think that East Asia will probably get back to full steam faster than the United States or Europe. And I think both in emerging markets in East Asia and even in Japan, I think that getting back to full steam earlier could be an advantage. So I'm relatively positive on East Asia equity markets and of course fixed income markets over the next few years relative to the US.
Great. Michael, one for you. So with the CARES Act withdrawal provisions, there's been a lot of talk about that the amount was set at $100,000, which is pretty high level for withdrawals. Have you seen any plan sponsors modifying those amounts and limiting them maybe at 50,000, or have there been any meetings to discuss any modifications among sponsors that you've worked with?
Yeah, a great question. Unfortunately, I don't have a lot of information on that yet. So just yesterday, we actually sent out to all of our clients election forms where they can make their CARES Act elections in terms of the provisions. And last night, as you would imagine, we had 100 of those forms returned. And so right now we're sorting through that information just to see, what that looks like. But I can tell you, just based on conversations that we've had with clients, there were a number of clients who found the need to go right up to that 100,000, but there were other clients who decided not to take any action at all. But we'll have more data on that over the next couple of days. But the conversations have been all over the place.
And I think we all should reemphasize the fact that, of course, there are people who are going to be in personal dramatic hardship who need to make those withdrawals right now, and the CARES Act is designed to try and help those people. But I think it's also important to ask the question, do you need to make that withdrawal? Because one of the problems with the defined contribution plans in general is that people may decide that every occasion is a reason to break the glass and make a withdrawal. And the problem is getting that money back in, because in the long run, you are going to have to fund retirement. So yes, if you have to do it, you have to do it. But if you don't have to do it, it's kind of like I've noticed, in the grocery stores all over America, you can't get toilet paper. Now, I've got to believe that there are basements full of toilet paper at this stage. But everybody just felt like they had to get toilet paper. At some stage, you don't really need to. And so again, if you've got the need, of course, that's what the thing's designed for. But you should still ask yourself the prudent question, do I actually have this need right now? Because you don't want to, if you continue to borrow from a retirement plan, it's not going to be there for you when you actually need it for retirement.
And Dr. Kelly, you're exactly right. And those are the conversations that we're having with the plan sponsors, because we're trying to balance in terms of what they're trying to do from a long-term perspective with this program, and find ways to also meet those short-term needs. And what we're finding is we have a number of clients who are more paternalistic, and they want to make sure that participants are keeping that long-term view versus that reaction to that emotional reaction to what's happening out there in the market and taking cash out of the plan.
Yeah, a tough decision for everyone, but thank you both for your insights on that. Those are very helpful, and I think we could go on for a long time. This has been very enlightening. We appreciate you both coming, but unfortunately, I think we're about out of time. I did want to add a few quick notes for our members before we close up. This is the first of 3 webinars that we're planning for this month related to the pandemic and how it's going to affect you. Later this month, we'll be talking about cybersecurity. Early data showed that cyber attacks have increased about 70% immediately following a lot of the stay-at-home orders that pushed most of you to work remote or to online meetings. So we'll have some tips for keeping yourself and your people safe in this new environment. We'll be partnering with 2 of our other industry associations, Spark, who many of you are familiar with, the Record Keeping Association, and DCIA, the DC Institutional Investor Association, for this webinar. The Spark Data Security Oversight Board has been taking the lead in the industry on creating cybersecurity standards for many of our members, and many of our members are on their board. So we'll be working with them for that webinar. It'll be hosted on DCIA's platform, so it's a little different than our past events, but it should be very thought-provoking. We're still working on some of the specifics for the timing for that event, but we'll have that information out soon. It'll be in the next couple of weeks. Also on April 30th, we'll host a legislative webinar to talk about the CARES Act, which we had many questions about today. We'll go a little more in depth on that, and whatever is in line next with any legislation that's about to pass, along with Secure, which is still out there, and there's still a lot of unanswered questions about, and the possibilities of a Secure 2.0, maybe next year, maybe sometime in the future. There was also a recently released GASB rule that could potentially affect 457 plans, and we have our own legislative priorities, especially our push for CIT inclusion in 403B plans. So we'll be talking about all of those. That'll be on April 30th. We'll have a very good panel set up, and we'll send out more information on that as that date approaches as well. And finally, we wanted to direct you to our COVID-19 resource page. There's a banner right at the top of the website to help you find it. Please check that out and add to it if you have useful information. We've had a lot of good provider resources and some thoughts from our members. We encourage you to continue sharing your story, as others may be able to benefit from the lessons that you've learned in your experience. We're all going through similar things, so it would be very helpful to share there. We've created it as an open platform so that you can all contribute. That's it for now. Dr. Kelly, Mr. Knowling, this has been fantastic. Thank you so much for taking your time to be with us today. We really appreciate your thoughts. We look forward to working with you again in the future. Thank you very much.
Thank you.
Great. Thank you.
All right. And take care, everyone. Stay safe out there, and we'll see you again soon.
Take care.